You're watching 71 million Americans make the same mathematical error with their Social Security benefits right now. Benefits increased 2.8% in January 2026, adding about $56 monthly to the average check. Everyone's celebrating the raise. Nobody's calculating the trap. Here's what I've learned spending decades studying how people actually build wealth versus how they think they do. If you're under full retirement age and earn more than $24,480 in 2026, Social Security deducts $1 from your benefits for every $2 you earn above that limit. Think about that arithmetic for a moment. You work harder, earn more, and the government takes back half your Social Security check. Not taxes, actual benefit reductions. But it gets more interesting. A new tax deduction up to $6,000 for those 65 and older could reduce taxes on Social Security income, though most people won't understand how to use it correctly. Meanwhile, Medicare Part B premiums rose to $201.90, consuming almost 32% of the average monthly COLA increase. The real wealth creators figured something out long ago. Trading hours for dollars is the most expensive transaction you'll ever make. Social Security's earning limits just make it mathematically impossible to win that game. There's a smarter way to structure your retirement income, one that doesn't penalize you for productivity. Let me show you what the numbers actually say. Now let me walk you through something I learned from observing financial behavior for over 6 decades. Most people operate on what I call received wisdom rather than actual arithmetic. They hear Social Security pays more if you delay, so they keep working longer. They hear Medicare costs are rising, so they work overtime to cover it. They hear inflation is eroding savings, so they take that weekend shift. All reasonable sounding decisions, all potentially catastrophic when you actually run the numbers. Let's talk about what really happens when you continue working while collecting Social Security before your full retirement age. If you earn more than $24,480 in 2026 and haven't reached full retirement age, the government withholds $1 from your benefits for every $2 you earn above that threshold. Now think about that transaction for a moment. You drive to work, put in 8 hours, earn $200 for the day. You get to keep your wages? Sure, but Social Security simultaneously claws back $100 from your monthly check. The effective tax rate on that work isn't just your income tax, your Social Security tax, your Medicare tax. It's all of those plus a 50% reduction in benefits you already earned. I've watched brilliant people miss this calculation their entire working lives. They see a $2,000 monthly Social Security check and think, I need more money, so I'll work part-time and earn another $1,000 a month. Sounds sensible, except if that $1,000 a month puts them over the earnings limit, they're not getting ahead. They're running in place while wearing cement shoes. The government gives with one hand and takes with the other, and most people never notice the second hand because it's not labeled tax. It's just mysteriously smaller Social Security deposits. Here's where it gets more interesting from a mathematical perspective. Those withheld benefits aren't permanently lost, but are returned once you reach full retirement age through higher monthly payments. The government treats it as though you claim benefits later than you actually did, so your permanent benefit increases. Sounds good, right? Here's the problem. You need to live long enough for those increased payments to make up for the years of reduced benefits. You've essentially given the government an interest-free loan, and whether you come out ahead depends entirely on your longevity and the opportunity cost of that money. Let me show you a different framework entirely. Instead of asking, how can I work more hours to earn more money, the correct question is, how can I restructure my income so it doesn't trigger the earnings test? This is where most people's thinking breaks down. They've spent 40, 50, 60 years in the employee mindset. Show up, put in time, get paid for hours. It's deeply embedded, but that model is specifically designed to keep you on the treadmill, and Social Security's earnings limits make sure that treadmill runs uphill. The wealthy figured this out generations ago. They don't trade time for money. They set up systems that generate income whether they're working or not. This isn't about becoming a millionaire. It's about understanding the fundamental difference between earned income and unearned income. Social Security's earnings test applies only to what they call wages or self-employment income. Income from dividends, rental properties, annuities, retirement account withdrawals, and investment gains doesn't count toward the earnings limit at all. You could have $10,000 a month coming in from these sources and Social Security wouldn't reduce your benefits by a penny. Think about the incentive structure this creates. The government is essentially telling you, if you remain an employee and trade your time for wages, we'll penalize you, but if you own assets that produce income, you're free to collect as much as you want. Now, whether this is fair social policy is a separate question. What matters for your personal decision-making is recognizing the game board you're actually playing on. So what does restructuring look like in practical terms? Let's start with the simplest example. You've got knowledge and experience from decades of work. Most people think the only way to monetize that is to get another job. But you could create information products, an online course, a consulting arrangement, a membership site where people pay for your expertise. The difference is crucial. When you work for someone else by the hour, that's earned income under Social Security's rules. When you create something once and it generates revenue repeatedly, you've moved toward passive income. Yes, there's work involved up front, but the income doesn't require continuously trading your time. Dividend-paying stocks from established corporations allow you to collect recurring payouts simply for holding shares. If you've got retirement savings sitting in accounts earning minimal interest, moving some of that into dividend-paying investments changes the nature of the income. Instead of working for money, your money works for you. The average yield for Treasury securities with 10-year maturity is running about 4.3% so far in 2026. That's real money on a meaningful principal, and it doesn't count against the earnings limit. Real estate operates on the same principle. You don't need to become a full-time landlord with multiple properties. If you own property you're not using, renting it out creates another income stream where you'll spend a little on maintenance but more than make up for it in rental fees. I know what you're thinking, being a landlord is work, and you're right. But the income from rental property is categorized differently than wages for Social Security purposes. You're generating cash flow from an asset, not from your labor hours. Now I want to be very clear about something. I'm not suggesting everyone should quit working. Work provides structure, social connection, mental stimulation, a sense of purpose, all critical to longevity and life satisfaction. What I'm saying is that if you're going to work, understand the economic reality of how that work interacts with your Social Security benefits. And if you're working primarily because you need the income, recognize that continuing to trade time for wages may be the least efficient way to generate that income given the penalty structure. Here's another angle most people miss. Retirees earn nearly $6 billion in revenue back into the overall economy through retirement side hustles, but very few structured those activities to minimize the Social Security impact. They took hourly jobs when they could have created consulting arrangements. They worked as employees when they could have operated as independent contractors with more flexibility around income timing. They accepted straight wages when they could have negotiated for deferred compensation or equity participation. The new tax deduction for people 65 and older complicates this further. The new deduction reduces taxable income by up to $6,000 for eligible taxpayers, potentially offsetting taxes on Social Security income. So now you're trying to optimize across three variables: the earnings test reduction, income tax implications, and this new deduction. It's mathematically complex, which is exactly why most people ignore it and just keep doing what they've always done. That's a very expensive form of intellectual laziness. Let me give you a framework for thinking about this differently. Start by calculating your actual financial need. Not what you think you need, not what you're used to spending, but the actual minimum required to maintain your lifestyle. Then look at your guaranteed income sources: Social Security, any pension, annuities. The gap between those two numbers is what you need to generate somehow. Now here's the critical decision point. You can fill that gap by working more hours in traditional employment, or you can fill it by restructuring your assets and skills to produce passive or semi-passive income. Most people never do this calculation. They just keep working because they're anxious about money, without ever determining whether the work is actually moving them forward or just keeping them busy. I've met people who are working 20 hours a week earning $12,000 a year, putting themselves over the Social Security earnings limit, losing $6,000 in reduced benefits, paying taxes on their wages, and ending up with maybe $4,000 net after all the calculations. They were working 500 hours a year for $4,000, $8 an hour effective rate. They could have achieved the same result by restructuring their assets or cutting a few expenses. The psychology of this is fascinating. We're tribal creatures with deep-seated instincts around work and contribution. Sitting still feels wrong. Generating passive income feels like cheating somehow, even though it's completely legal and actually encouraged by the tax code. So people keep working harder instead of working smarter, and the Social Security system reinforces this behavior through its earnings test. It's a beautiful example of how policy can shape behavior in ways policymakers never intended. Consider the opportunity cost angle. Every hour you spend in a traditional job is an hour you're not spending setting up income-producing systems. If you spend 200 hours over 6 months creating an online course, or building a dividend portfolio, or establishing a small rental operation, that initial time investment could generate income for years. But if you spend those same 200 hours working hourly jobs, you get paid once for each hour and then it's gone. The first path builds equity. The second path trades your most valuable non-renewable resource, time, for money that may be partially clawed back by Social Security anyway. Let me address the obvious objection. Charlie, this all sounds great for people with money or special skills, but what about regular folks with limited savings and no expertise? Fair question. Here's my answer. Everyone has something. You've lived 60, 70, 80 years. You know things. You can do things. The question is whether you're willing to package that knowledge or ability in a form that generates income without requiring you to continuously trade hours for dollars. People are succeeding with pet sitting, tutoring, consulting in their previous field, creating online content, renting out space, all activities that provide more control over income, timing, and structure than traditional employment. The compound effect here is extraordinary. If you can shift even part of your income from earned to passive, you not only avoid the Social Security reduction, but you also potentially lower your overall tax burden and free up time to generate additional streams. 3 years of focused effort restructuring your income could set you up for a decade of financial security. Or you can spend that same 3 years trading time for dollars at an effective rate that makes no economic sense once you account for the benefit reductions. This brings me to my final point, and it's the one that matters most. The purpose of money is freedom. Freedom to make choices, pursue interests, spend time with people you care about, live without constant financial anxiety. Traditional employment and retirement gives you money, but takes away freedom. You're on someone else's schedule, showing up when they say, doing what they assign. That might be fine if you love the work, but if you're doing it primarily for income, you're making a terrible trade, especially when that income triggers a 50% reduction in benefits you've spent a lifetime earning. I've spent decades studying what separates successful decision makers from everyone else. It's not intelligence or education or luck. It's the willingness to question received wisdom and do the arithmetic yourself. Everyone knows you need money in retirement. Very few people actually calculate whether their current approach to generating that money makes mathematical sense, given the incentives and penalties built into Social Security. Even fewer are willing to do the hard work up front to restructure their income sources. But those who do, those who shift from trading time for money to building income-producing assets and systems, they're the ones who actually escape the employee trap and achieve something that looks like genuine financial freedom in their later years.